A TM deposited. Funds showed up. But then what happened? Is that money just sitting in a vault? What does the bank do with it? Where does the interest they pay you come from? And the real question, why is the whole system so fragile yet somehow still works? The moment you deposit money into a bank, you're making an invisible agreement. That agreement keeps the economy's heart beating. Let's open that heart and look inside. As soon as the money hits your account, the bank's computer relabels one thing. You are now a lender. It sounds weird. No one ever says, "I loaned money to my bank." But technically, that's exactly what you did. The bank makes you a promise. You can withdraw your money whenever you want. And in return, a small incentive, interest. Because a bank's job isn't to store money. It's to circulate it. It takes your $10,000 and lends it to someone else. That loan becomes a business, a salary, a purchase. Money moves. And as it moves, the economy breathes. But here's the critical question. If the bank lends out your money, how does it give it back when you ask for it? To answer that, first we need to understand the system. A bank lives on two pillars. On the left, loans, the assets. On the right, deposits, the liabilities. When you deposit money, the bank owes you. When it lends money, others owe the bank. The difference? That's the bank's profit. Let's say the bank collects money from you at 20% and lends it out at 40%. The 20% difference is called the spread. That's how banks make money. So why doesn't this system stop? And what happens if it does? The answer lies in its hidden rule. Your money isn't sitting in the bank's vault. Your money is someone else's debt. This is called the fractional reserve system. The bank keeps a small portion on the side and pushes the rest into circulation. And that's great for the economy. But it's also where the danger begins. What if everyone tries to withdraw at the same time? That's a bank run, and that's where the system gets tested. A bank run starts when people suddenly think, "My bank is going to fail." People rush to withdraw. But the bank can't pay everyone instantly because the money is out as loans. The bank freezes. That's why governments spend so much effort protecting trust in the banking system. That's where deposit insurance comes in. Up to a certain limit, the government says, "Don't worry, your money is safe." The economy runs on trust. When trust disappears, the system stops. So when you deposit money at an ATM, you're dropping a small unit of liquidity into the system. That drop becomes credit, salaries, purchases, and eventually finds its way back to you. Banks don't store money, they circulate it.